One is that using the secondary market is really smart for a number of reasons. That's why you see some of the most sophisticated investors, both on the LP side and the GP side, using the secondary market and using it programmatically. What drives pricing is buyers' view of where NAVs are heading and how we feel about whether asset valuations are overstated or understated. Look, if private market assets are $20-30 trillion in 2030, let's say conservatively 75% of that AUM is mature or seasoned enough to be sort of available to trade in the secondary market. And if we just apply that sort of historical rate of 1% per year, it's very easy to imagine that annual secondary volume would be in the range of $250 to $300 billion per year.
Hi, everyone. Thank you for tuning in to another episode of Women of Secondaries, produced by Secondary Link and hosted by yours truly. My name is Kristina Kulikova. I'm the VP on the LP advisory side of Setter Capital, and I'm absolutely privileged to host Women of Secondaries, where we cast light on the incredible powerhouse women driving this market. If you missed our prior episodes, make sure to check them out on the Secondary Link's video and podcast section, YouTube, Spotify, or catch short snippets of the discussions on the Secondary Link's LinkedIn page. On this episode, I have the absolute honor of chatting with a partner at one of the major secondary players in the industry and a regular buy-side firm that I personally have had the pleasure of working with over the last 11 years, Ares Management. With a global presence across North America, Europe, Asia Pacific, and the Middle East, Ares is a global alternative investment management firm covering essentially the whole spectrum of alternative assets, including, of course, secondaries, through the Ares Secondaries Group. With over 3 decades of secondary market experience and over $25.6 billion in AUM across real estate, private equity, infrastructure, and credit, I couldn't think of a player with a better viewpoint on the state of the secondaries market today and its evolution than the experts themselves. With that, I'm very excited to welcome not only a personal industry idol, but also a brilliant mind and an intelligent investor and a longtime tenured professional in her field with over 25 years of experience in secondaries, a partner in the Ares Secondaries Group, Kathryn Regan. Welcome, Kathryn.
Hi, Kristina. How are you?
Good. I'm so excited to have you on.
Likewise. Thank you so much. It's a privilege.
That's awesome. And now before we jump into the main part of our chat, I know we've had the pleasure of being in touch on various opportunities throughout the last couple years while I'm at Setter Capital. But your journey with secondary started a much longer time ago. And so perhaps you can delight our audience with some background on how you ended up at Ares and in secondaries in general.
Yeah, sure. So I don't know that I ended up in secondaries because it's really where I got my start. One of my college internships was with Landmark Partners. And during the course of that summer, I was supporting an associate. She became my first mentor in the industry. She is still a dear friend and a sounding board. I spent that first summer primarily monitoring and producing the quarterly reporting on Landmark's first secondary fund. And I was just learning as I went. I had zero background in private equity. The summer before, I worked as a waitress. I was running lobster specials up and down a flight of stairs. But I was an econ major with a business minor at Villanova University. So I had an intro to finance and accounting classes under my belt, but it really was just learning on the job. But just reading those quarterly business reports for the buyout funds, the venture funds, reading all about portfolio companies, what they did, how they were trending against their investment thesis, and pulling apart what was driving valuations quarter over quarter, and a fair amount of data entry. It comes with the territory. But I really enjoyed it. I found it fascinating. I did well enough that I was offered an analyst position. Over the course of the years, I've worked alongside amazing people that I continued to learn from and grow. And the rest is a lot of history. And now I've been part of the Ares family for 3 years. with the acquisition by Ares of Landmark in 2021. And that just offered me a whole nother chapter of exciting times to come.
Well, I'm sure the lobster bisque didn't keep you, and the secondaries industry is lucky to have you. So, now let's get into the main part of our chat today. Obviously, I think our audience are very excited to hear from such a tenured professional. And given the rapid, and I can even say exponential rise of secondaries over the last decade, going from I think under 30 billion in volume to over 130 billion in volume in 10 years, secondaries are a vital part of the capital markets, obviously now, and that's not to be ignored. And still, I believe it's around 1% of total private capital markets unrealized value, leaving huge potential for growth. I would love to hear your take on the scale of secondaries today, and with some rumblings that total private alternatives volume may hit something like 30 trillion by 2030. What do you think secondary market volume could look like by that time? And is it a linear extrapolation of like a 1% share, or will its growth trajectory accelerate?
Yeah, I mean, first of all, it's wild to think that 2030 is only 5.5 years away. Those 20 and $30 trillion estimates for private markets are total AUM, right? And that includes secondary AUM. I think there's a recent PitchBook report on private market AUM growth that includes secondaries. That puts current secondary AUM at 460 billion, growing to 700 billion over the next 5 years. But to your question on sort of annual volume, look, if private market assets are $30 trillion in 2030, let's say conservatively 75% of that AUM is mature or seasoned enough to be sort of available to trade in the secondary market. And if we just apply that sort of historical rate of 1% per year, it's very easy to imagine that annual secondary volume would be in the range of $250 to $300 billion per year. That's roughly a doubling or a little more than doubling of the $115 billion of secondary transaction volume in 2023. So, a doubling over the next 5 to 6 years is certainly reasonable. I think it's probably conservative. I know we have colleagues in our space that are calling for $1 trillion of annual volume in that time period. The constraint, and this is probably going to another question that you're going to mention, the constraint for secondaries volume, especially in the single asset and multi-asset CV space, has really been capital fundraising. So if that fundraising nut can be cracked, which I think it can and will be, given the attractiveness of the return opportunity in the GP secondary solution space, then I think, we blow well past that $300 billion of volume per year. And then if you factor in the growth of pref equity solutions or structured solutions and NAV lending and even lump in GP stakes and other innovations yet to come in the next 5 years, that really expand the definition of what a secondary is. And that's just, further upside on volume on an annual basis from there.
Yeah, it's going to be interesting to see how secondaries specialize. And as you said, go into these more various and niche strategies. And I think to the Prequin's latest report, I also read somewhere that, their secondaries fundraising hit like 93.8 billion in 2023, which was like an astounding 159% increase on 2022 numbers. That was just phenomenal. And I think just substantiates your point that we're going to continue to be on that growth trajectory. But yeah, hopefully the capitalization continues. Now, COVID obviously changed a lot of things, whether it's the dip in the public markets, the rise of the almost unjustifiable valuations in some cases, and capital raises in the venture space, the near obsolescence of some industries and rise of others, and of course, subsequent rise in interest rates at, I think, probably a historic high in terms of pace. When you look at the types of deals done in the market pre and post-COVID, what are the most notable differences, if any?
I think the most obvious difference is really that the GP-led part of the market represented about 1/3 of volume pre-2020, and it's been really near or over 50% of volume in the years since. So maybe that's more of an obvious one and gets a lot of coverage in the market. But a few other trends I would note. One you touched on, is sort of the more conservative use of transaction level leverage in the secondary market. And that's a function of the fact that interest rates have risen really since the first quarter of 2022. And then the other interesting thing worth noting, I think, is the increased volume of private credit secondaries. That's been driven by a number of tailwinds, including the growth in mature private credit AUM, but also dedicated buyer capital to the asset class that now has the right cost of capital to take down that type of asset exposure. It supports a improved price point where sellers are willing to transact around those assets as well. And then also driven by a fairly quick adoption by private credit sponsors to utilize the secondary market for solutions. So really getting into sort of the GP-led part of the secondary market and adopting that in a pretty short order. We're seeing a lot of opportunity on that side.
This is a little bit maybe off the cuff, but kind of elaborating on that, do you think there'll be a period where GP-leds become sufficient enough driver of liquidity for the market that we may not see as many LP-led deals anymore?
No, I think both continue to grow. I mean, LPs will continue to utilize the secondary market for their own strategic reasons, active portfolio management, changes in strategy, regulation change, all the historical reasons of why LPs have used the secondary market. I don't really see that changing. I really think that it's more that GPs will continue to leverage the secondary market as one of their available exit strategies for their portfolio companies and continue to grow.
And so extrapolating from that background, some believe that post-crisis eras or times of great market dislocation bring on the strongest vintage funds, whether it be post-GFC or post-COVID. In terms of secondary funds, what do you think was the strongest vintage year to date and why? And will 2024 potentially be one of those years as well?
Yeah, well, we have the data, right? We can look at the data. We have a quantitative research team, so they give me all the data we need. But if you look at historically IRRs and multiples on a pooled basis, 1993 was actually the best year. But I don't think that's a very relevant comparison to the current secondary market. So we probably need to pick a time period that's a bit more relevant. And probably we want to exclude some of the most recent vintages because those performance metrics are not mature yet. So if you look back, the pooled IRRs for secondary vintages is actually pretty consistent with a couple of exceptions. 2005 to 2007 vintages generated kind of a 5 to 6% pooled net IRR and 1.3 to 1.45 multiples. Those vintages were invested in fairly peaky years or public market valuations and fundraising, but then also, because of the GFC, liquidity dried up, extending the duration of those portfolios. So not entirely surprising that those years were not the best. But if we look at the post-GFC vintages, I would say generally the IRRs have been in the mid to high teens with multiples in the 1.5 to 1.6 net range. In more recent years, like 2016 seems to be looking quite strong, especially on a net multiple basis, currently showing a 1.7 times net, again, on kind of a pooled basis. Certainly there are funds that have outperformed that or underperformed that. So when you think about, that time period and secondary managers buying assets in the 2015 to 2017 period, it's a period of fairly reasonable valuations followed by strong public market appreciation, a very strong exit environment through 2019. So it makes sense that those vintages, the returns there look quite solid. So the second part of the question is around whether 2024 is going to be a strong vintage year. I think absolutely yes. Well positioned for attractive investment period, certainly in the near to mid term, being because private equity valuation, I'm speaking to private equity because that's what I live and breathe every day. Private equity valuations, which we thought were overstated in many cases for a good part of 2022 and 23, appear to have kind of come back in line as financial performance has sort of caught up to some lower valuation multiples. So we think from a buying standpoint, there's an opportunity to buy assets at fair valuations. There's ample supply of transactions in the market, both from the LP side and the GP side, given the lack of distribution activity that we've had in the market otherwise. And then just the creativity in the marketplace and using structured solutions and negotiating transactions that win for all parties to help to unlock further deal flow for attractive risk-adjusted returns. I think all of that adds up to 2024 being a really strong year for activity, but also for strong return generation. I think we touched on this too already. I think going forward, what I'm interested in thinking about more is how our secondaries benchmarked. Given the trend of specialization, should a fund that specializes or focuses more on LP-led transactions really be benchmarked and bucketed in the same sort of vintage year as a GP-led CV-focused secondary fund? And they're very different strategies and very sort of risk and return objectives there. So I don't know, they'll probably still all get bucketed together, and it'll be on all of us market participants to distill it down and educate the marketplace and help everyone understand the differences. But I think that's actually going to be pretty interesting going forward and trying to explain and parse apart.
Yeah, it's the same. It's a very valid point. It's the same as, you wouldn't necessarily compare the performance of an infrastructure fund with a buyout fund, right? They're completely different asset classes. And so, yeah, the more specialization, I think the more it'll have to be segregated into the different categories for comparison. Well, I know you mentioned that you have a data and research team behind you, but I think your numbers cold. And so thank you for that answer. I think that was fascinating to hear your thoughts on that. And so what are the biggest industry verticals that you expect we will see the largest volume of particularly buyout secondary deal flow from this year? Perhaps starting with the LP side and then moving on to GP-leds and CVs.
Yeah, so from the LP-led or LP portfolio side of the market, the breakdown in sector or geography, I think it typically mimics the industry composition of broader private equity benchmarks. I think there's no real reason to think it will differ materially. The LP portfolios are diversified. I'd say maybe one caveat recently and potentially going into this year is around tech-focused funds. It remains a little bit tough from a pricing standpoint, with buyers still thinking that private valuations are maybe a bit overstated, depending on the vintage of the tech fund and when it made its investments. So, maybe that's been probably a little bit lighter just because the pricing isn't as strong there, but that may improve over time. And so just diversified generally, nothing I don't think too notable for this year. And then on the GP-led side, I would think a continuation of what we saw in 2023, sort of more volume in healthcare, financial services, business services, transactions. I think those will continue to be sort of favored industries for CVs in 2024. That being said, there are multiple multi-billion single and multi-asset CVs around tech assets that are owned by premier sponsors. They're either in market or coming to market. I think the key for those transactions is going to be around pricing and whether buyers can offer a price that fits what the GP is trying to achieve for its LPs, and making sure that the price is something that the LPs are willing to elect to sell those assets at, or whether they decide to hold. I think that's one of the big questions around that part of the market.
And so I know I keep bringing things back to COVID, but just I think that was like the last major economic event that really impacted everything. Are there differences between the reasons you found driving sales in buyout deals right after COVID compared to, let's say, now when the markets have maybe stabilized a little bit more, whether it's LP fund deals or GP-led?
I think that across the board, the main driving force for secondary transactions last year and again in 2024 is really the lack of PE exit activity. And so that's probably driven more by some inflationary pressures that resulted in an increase in interest rates and just sort of a drying up of some of the activity and liquidity. So that's, I think that's really what's driving LPs who require distributions for their funding or for their commitment needs to bring large portfolios to market. I think what's a little bit different, and Kristina, tell me if I'm wrong because you live and breathe this all the time, but we've seen a number of deals coming to market where buyers are really opening up their books and saying to buyers, like, you tell me, what are you going to buy? What will you price the most attractively? And bring to market like really large portfolios to say like a $4 billion portfolio, but really looking for $1 billion to $1.5 billion of liquidity, but letting sort of buyers pick and choose based on their best priced assets.
I totally agree with you. And I think that actually has to do with the comfort level that LPs are getting with secondary transactions, period. Because a lot of the time before, it was very selective. They had to be selective on which GPs they don't want to necessarily ruin relationships with, or it was a little bit more taboo, right? And then, of course, the pricing element, but they didn't want it as broadly understood in the market that they may be a seller, versus now a lot of that is sort of almost dissipated, and there's a lot more comfort with mosaic solutions and not just a single buyer and all that. So, and syndicate deals.
And I think in terms of what's driving, that it has really been just a lack of distribution activity elsewhere that you would expect in sort of more normalized sort of exit environment. To the point on the mosaic, I would say we've seen that change a little bit this year so far in 2024. We've started to see instances where the mosaic solution and the combined pricing from multiple buyers actually is not as attractive as groups that are coming in for total portfolio solutions. So it could be just sort of the past quarter or so that's happening, but we've seen a little bit sellers interested in evaluating those mosaic solutions, but ending up deciding to go the route of a full solution.
Do you think that's in part because some of the larger players, I mean, they've always had very large teams to be able to underwrite deals and et cetera, but there have been groups that have acquired divisions, let's say like private credit divisions. So now they could also bid on private credit, or they could bid on more specialist, niche parts of the portfolio that maybe, given the maturization of the market, now they're able to do that. Whereas before they were just focused on, just the buyout or just the infrastructure, or just like the specific geography. Maybe that's part of it as well, that they just have more capabilities and more knowledge and more resources now to diversify and bid on a more diversified portfolio.
That would make a lot of sense. I think that's fair. And just to sort of close out the question around the main reason for selling on the GP side, certainly similarly, the typical exit paths, whether it be IPO or M&A, have just not been as available recently. So that's certainly part of the reason why GPs are coming to the secondary market to generate liquidity, whether it's through a single or multi-asset sale or a NAV facility or pref equity solution for that matter. But even in like 2021, when exit environment was still strong, that was still a big year for GP leds. So I just think it's just a exit route that GPs have accepted. They're using it as part of their own portfolio management toolbox when they have assets that they want to continue to own beyond the typical hold period. Pursuing a secondary market exit can again be a win-win-win for everybody involved.
There's also been a big talk about how CVs have evolved from being kind of the zombie assets that were difficult to sell to now the trophy assets, right? That the GP just wants to hold longer and make sure they actually get the return versus their competitor. Do you think though the GP like CV market will completely evaporate for the distressed assets or sort of less preferable assets? Is there going to be a different solution for that route, or is it going to completely flip to kind of performing asset CVs?
Don't spend a lot of time thinking about what's going to happen to those assets because it's not where we focused at all. I don't think we'll be spending a lot of time necessarily. I think we focus on quality assets, GPs that are around for the longer time horizon.
Now I know a couple of the deals that I want to talk to you about. I won't bring them up to you. but look, being potentially on both sides of the market sometimes in your seat and with your wealth of experience, generally, what is a suggestion you would give to a first-time seller who is considering selling into the secondary market, and perhaps more of an LP seller? Because we see this all the time, but I'm curious from your perspective as an actual buyer.
Yeah, so you're definitely closer to that process and consulting potential sellers. But I think what I would say, and obviously we do have investors that we talk to on the regular about, their options. One is that using the secondary market is really smart for a number of reasons. That's why you see some of the most sophisticated investors, both on the LP side and the GP side, using the secondary market and using it programmatically. The secondary sale really opens your options for redeployment of proceeds and redeployment from the release of those unfunded commitments. And that can really accelerate your achievement of your organization's, goals and objectives. My suggestion to any owner of private assets that's considering a secondary transaction is to really have a plan around how they're going to use that excess capacity that a sale creates. How is that really going to impact your strategic objectives and your timeline to achieving them? Do you have the opportunity to redeploy into higher returning opportunities? Would a secondary sale relieve some constraint on what you're otherwise going to do with your program or your fund or your portfolio company? And maybe in that sense, you can absorb a discount or a loss because it then does get you to where you're trying to get more quickly and drives the broader strategic objectives for you.
And I remember hearing somewhere, maybe more of a controversial statement. I think it was in another podcast, actually. And they said, who's to say, or who originally decided on the fact that, private funds need to be 10 years and they need to have this continuum and you have to keep them for 10 years. Meanwhile, your return targets or your cash flow needs or whatnot may change that cycle. And so maybe we're actually on the verge of a whole revamp of kind of private markets considerations, right? Of how long should private funds be for. Now with the evolution of secondary markets, people seeing more returns sooner, so that's a whole other can of worms, which we won't go into today, but there's some validity to that.
Yeah, for sure.
And so being in your seat, I can only imagine the volume of deal flow that you must see come your team's way, whether it's from us, whether it's from other advisors, whether it's from your direct relationships. And first of all, I applaud you for being able to sift through all that. And when you select deals you like, what is the biggest obstacle you face when you underwrite that deal, whether it be a fund or a co-investment?
I think the biggest obstacle and the most consistent reason we'll sort of go pencils down once we've started to work on something is the available information. It's very important to our strategy, our investment process, that we have some sort of informational advantage so that we feel like we can price and structure the transaction optimally. That advantage can come from the tools and research that has been developed by that quantitative research group within Ares. It can come in-house from industry expertise and relationships across the Ares businesses. And it can come from the expert experience of our secondary teams, right? We specialize in private equity, real estate, infrastructure, and credit. And so we can leverage our prior experiences and knowledge as well. And we're pretty steadfast in our triage process. And if we don't feel like we have sort of the informational advantage, we don't have a problem putting our pencils down and moving on to sort of the next opportunity, given there is such a wide and strong funnel of opportunities.
Yeah, because you have to be able to justify your decision, right, for why you're acquiring, said portfolio. And I guess to play into that, I assume GP calls play a vital role in part of that due diligence, right, especially if it's like funds where there's little overlap or companies where there's little overlap internally. And maybe as you were saying that, I was thinking that's another important point for sellers to keep in mind, is that oftentimes information asymmetry or lack of could drive a discount as well, just because you're putting in kind of that larger risk premium into the deal.
That's right. And I should note, there are probably ways that we have and we would structure a deal around it, right? We'll have some sort of downside protection if the counterparty is willing to remain exposed to those assets, where we'll try to take a larger than pro rata share of the distributions coming early back to help de-risk the portfolio, and then if it outperforms, then the counterparty participates more in that upside as well. So that's another way to structure around it.
And I find that oftentimes the sellers in those situations, they also don't have that access to information, or they just don't know enough from the GPs. And so it benefits everybody in the deal potentially, right? Because you do have that additional layer of not necessarily timing the market and timing the information that you have and relying on it. So that's interesting that you bring it up. So before we wrap up this section of our chat, some will say I left the best for last. And of course, that's commentary on pricing. At least from my seat as an advisor, it seems that sellers have, for the most part, increased their pricing expectations on mega cap and mid-market LBO funds, particularly in core markets like North America and Western Europe, to potentially even pre-COVID levels. That's kind of like near the par premium territory. In part, maybe that's driven by the adjusted valuations, but improvements in the public markets, et cetera. What is your take on current pricing for buyout funds? Maybe what drives the most variability in the pricing? And then lastly, have LP stakes generally become pricier than GP-led deals on some occasions?
So generally what drives pricing is buyers' view of where NAVs are heading and how we feel about whether asset valuations are overstated or understated. If we're looking at reference dates now as of year end 23, and the public markets have continued to experience positive performance, then you feel like a little bit better paying a fuller price because you're expecting those net asset values to at least remain flat, if not improve. The other part that we think about as buyers, particularly on the LP portfolio side, is the exit environment and the distribution velocity. How quickly is our NAV going to be realized? And I think that there are some expectations that 2024 is certainly going to improve over 2023, and that things will hopefully open up over the near term. And so those two things combined can typically support higher pricing. And I would also note that we are definitely seeing pricing come up on LP portfolio. So I agree with what you noted. And I think we've been a little bit surprised by it. We were very busy in the LP part of the market in 2023 and going into 2024. But I think most in the second quarter, we've been a little surprised and maybe not as successful given where pricing has come out, and the brokers involved in some of those processes have been surprised as well in terms of where things have come out.
You're definitely not the only one that's sounding that sentiment, because across the board, large scale firms are also, they're saying that's impossible. How is that pricing there in the market? And I'm curious if that's like because of really market forces in terms of economic forces, or it's the amount of capital that's now trying to be deployed by, secondary funds. Could be a bit of both.
I think a bit of both is fair. Certainly there was a lot of capital raised, I think, as you mentioned, last year, and some of that capital, or a lot of that capital, is focused on LP portfolios, so that makes sense. We still think there's a pretty healthy balance of capital supply and demand on the LP portfolio space, but it's nothing like it is on the GP solutions side, where there's just not enough capital to keep up with the amount of deal opportunities. In terms of LP deals being less attractive than GP deals from a pricing, or I guess return perspective, I think maybe this is a weak answer, but I think it depends, right? They're quite different exposures in terms of risk and reward. I think it depends on what the objective is for a particular secondary fund or vehicle. What are you trying to achieve? Where are you in your deployment? What do you need to achieve your portfolio strategy? So I don't see it as less attractive. The luxury that we have is that we can move in and out of the different parts of the market depending on where we see the best opportunities at any point in time.
Yeah. So what I'm hearing from you is, pricing can't really be the only factor that you're evaluating. And I'm sure it's not for many groups, right? But it's not a fair comparison to make just between pricing for LP and GP-led deals, because they're completely different in achieving the objectives that they're aimed at achieving, essentially.
Yeah. Well said.
Thank you. And so, tied into the discussion on pricing, with the extended coverage of secondary market activity, research data reports, trading platforms emerging for both fund stakes, GP-led deals, VC direct companies, the level of transparency in the market is definitely increasing, right? Whether it's on transactions or pricing, et cetera. What's your take on this increased transparency when it comes to the secondary market? Is it more of an arbitrage killer where now there's less information asymmetry, or is it a path to growth?
I don't think that the lack of transparency specific to pricing is a material driver of arbitrage. Each sale process is is so unique with different combinations of funds and exposures. It's kind of a little bit hard to see how increased transparency really changes things all that much. I think actually pricing transparency will help to educate both buyers and sellers in a way that makes that process a bit more efficient. And I think we find excess return in other places, not based on sort of price transparency. And furthermore, I think that having some price transparency actually can help us from a resource allocation standpoint. Like if we know that we'll be competitive on a fund because we know the pricing, but we think we know something better or we can price it more aggressively, then we'll lean in and we'll work on that. Or conversely, like if we don't think we're going to hit the bid that a certain fund has been trading at or a set of funds has been trading at, we know we're not going to be competitive, then we can sit back and move on to the next one. And for sellers, I would think it would also help to grow the market because they may get more comfort, right? Having that market insight, knowing or believing that they're not getting a bad deal because they have more transparency on other pricing being offered in the market. I think the informational asymmetries that really matter are really between bidders and around specific assets or your knowledge of the fund or the managers. I think those are more important drivers of informational advantages. And that's where we believe you can capture and create excess return for your investors.
So would you say when it comes to a seller, it can actually help expedite the transaction and actually have more likelihood of it coming together rather than dragging on and everybody's resources are wasted and it doesn't come to fruition? And maybe that's what's going to actually increase the secondary market volume even further if there is that transparency and people can come together, versus maybe from a competitor standpoint, that's when it gets trickier because you are kind of, your main advantage is the information, right, that you have on the assets. Awesome. And so this is the part of our chat where we can touch a little upon, deal performance considerations and the like. And I think a lot of market participants, whether they're on the buy side, sell side, or just monitoring, often wonder, to be a compelling secondary opportunity, what components or parameters does a deal need to have? Perhaps starting with the fund level and then the co-invest level.
I think generally speaking in the marketplace, buying performing assets that have appropriate capital structures, that are owned by quality sponsors, strong management teams that have demonstrated success historically, maybe even as important that they are aligned with us in terms of the future value creation. That's extremely important, getting that alignment right. The other parameters include that the projected returns for that particular transaction are accretive to the fund or the vehicle that you're investing from relative to the risk profile of that specific deal. We like deals that have some sort of inherent downside risk mitigation. That can be due to an industry dynamic, a company's business model, the nature of its contracts. It could be contractual or structured downside protection itself. I think I mentioned this before, but the informational advantage, like an Ares angle, is pretty important to us, that we can triangulate, what we're hearing from a GP, internally with, independently to really get conviction in our diligence and our underwriting case. Things that we also think about are that particular transaction is accretive to our portfolio construction objectives and then the characteristics that we are looking for. And then also that it fits within our risk framework, that we're not taking undue industry concentration risk or FX exposure. So those are things that we'll think about in our process as well. And then, sort of wrapping up, that is from an ESG standpoint, we spend a good amount of time looking at the underlying portfolio companies in any transaction that we are bringing to our investment committee to screen and make sure that there is no exposure to something that doesn't pass our ESG policy.
Yeah, that's it. Sometimes we'll talk to sellers, and funny enough to hear sellers say, every asset has a price or every opportunity has a price. And that may be true, but what I'm kind of taking away from what you're saying is it's not always for every buyer, right? That opportunity is not going to be for every buyer. There's parameters that they need to be
Mhm.
conscious of and considering. So yes, maybe it does have a price, but it doesn't necessarily mean it's a good secondary opportunity for you, specifically as a firm, right? This is sometimes a vastly debated topic when it comes to performance metrics. Specifically as it relates to secondary deals, however, what metric do you think is more important when considering a deal? Is it MOIC or the IRR, and why?
I'm going to sound a bit like a broken record, but it kind of depends. And I think it depends again on what the strategy is for our secondary, funds or vehicles, or how they're the terms of those specific vehicles. So, for example, what kind of tools do you have? Like, does the vehicle have the ability to recycle? What sort of leverage is the vehicle able to use? So, for example, we might consider looking at a mature, diversified LP portfolio that is projected to have a high IRR and a lower multiple because of the cash flow yield that's anticipated to come along with that portfolio. That is attractive to us. We can recycle some of the proceeds, or maybe because it's so diversified that allows us to access a little bit of leverage. So there can be, portfolio strategy considerations of why you might accept a higher IRR and a lower multiple on a specific deal. That doesn't mean you're sacrificing the returns for your overall fund. I mean, our return objectives for our fund are what they are, but you can, build to that return through different types of transactions and what they do for your overall fund. So we're trying to generate both for our investors, right? A attractive IRR and a multiple that is, above maybe traditional secondary fund returns. But there are multiple ways to get there.
Is there ever a scenario in which you would only look at one of those metrics?
No, I don't. I
No.
can't envision a case where we wouldn't look at both.
I get it.
We never have, so I'll say it that way.
I was expecting that answer, so it was more of a trick question. But no, I was reading a LinkedIn post somewhere that they said, let's disregard the IRR completely and see what happens to the performance of the deals just from a MOIC perspective. And I didn't expect you to answer it any other way. But well, look, thank you for sharing all your insights on the market. And I think this next part I was probably even more excited for, because I know you as an industry professional, obviously for many, many years, and to hear your insights on the market is always fascinating. But I won't lie, I do want to get to know you a little bit more as a individual, and I'm sure our audience would love to as well. And so if you would play along with me on some rapid fire questions that are a bit more personal based, and would love to hear your responses to this. What time do you wake up in the morning?
I'm an Orange Theory enthusiast. I try to get there 3 to 4 times a week, and so if my alarm gets set for 5:25 a.m.
Wow.
If I'm not going, I still like to get up ahead of when my 13-year-old daughter wakes up. So that's probably 6 or 6:15.
Early bird gets the early worm. And what's your daily goal when you get into the office?
I really like to be prepared. I'm kind of laughing because I feel like people tease me about it, but I like to go into meetings, presentations, phone calls, whatever it is, very prepared. So that's my goal, is to be prepared for every one of those conversations or discussions. That doesn't mean I am 100% hit rate all the time, because other demands come up during the course of your day. But that's definitely my goal.
Yeah, it's. I was reading this journalist interview, and they said you over prepare, even though you might prepare for 4 hours for a 1-minute speech or for a 30-second speech, but you never know what might come up within that 30 seconds, right? So,
right.
What's your favorite part of your job?
It's a toss-up, I would say, between the opportunity to learn and help other people using my experience and knowledge. I think it's a privilege to be in the position that we are in the secondary landscape, where we sit in the marketplace. And that Ares is an exceptional place to be as well, in terms of accessing such a broad range of investment professionals, internally on a daily basis, working with people who are so willing to give you their time and share their knowledge, and they're such experts in their own fields and their own investment strategies. It's amazing. But I hope both internally and externally, I'm not just being completely selfish and learning, but I'm also I tend to gravitate towards projects even outside of the investments day to day, where I can lend my expertise, lend my knowledge, and help in some form or fashion. And I really do get something out of being helpful and seeing how I can help influence and get others, whether it's investors or other colleagues at Ares, to where they're trying to get.
It's awesome. And it's, in all of my interactions with you, it's always been a pleasure. And so whether it's in terms of knowledge sharing or kind of just inspiring me for things. So I appreciate that as well.
You're kind. You're very kind.
And now there's always the flip side of the coin, though. And this is maybe, sometimes there's moments that things you don't want to do or things that irk you or things that maybe you just don't feel, you're best suited for or whatnot. What's the least favorite part of your work?
Losing deals. I hate losing deals.
I 100% agree.
Yeah, when you come up short, when you and your team have worked hard on the diligence, underwriting, got conviction, got buy-in from the rest of the team and the investment committee, and it's part of the business, it's part of the transaction process. It is what it is, but it doesn't feel so great.
Yeah, I think you definitely have to be passionate about your work and what you do, and put your whole heart into it to then feel like, oh, I take it personally. That's unfortunate that broke down. I couldn't agree more. And yeah, you're a big inspiration to a lot of people in the market. But who has been your biggest inspiration and maybe biggest positive influence, specifically in the industry to date?
Yeah, I've been lucky. I've worked with a lot of amazing people. They've had a material impact on the secondaries market overall and influenced me as well to be a better investor. I'm not going to name names, which I know you want me to. But I
Keep
will give you
it
one thing.
politically correct.
I'll give you just one thing that I think did have a positive, very positive influence on me at a key point in my career. And that was the Women's Private Equity Summit that was founded by Beth Falk about 17 or 18 years ago now. Probably Googling industry events to attend and came across that. And I went to either the first or the second one, so pretty early on. If people don't know about it, is one of the events in the private equity industry, especially for women, extremely well attended. But at that point in my career, I wasn't senior. I didn't have exposure to many senior female leaders in private equity, particularly in investment type roles. So attending that event, it was very influential. It gave me a vision of what my career could be and a model for that. And so I think that it really had a big impact on me, that like, oh, this is something that I can stick with and continue with and become one of these, panelists down the road.
I think you actually answered another question that I did have prepared for you, which is, what is the impact of more senior women in leadership role have on the industry as a whole? And I think you hit the point on the head that it's inspiring to see where your future self could be in 20, 30 years from now. But what do you think our industry may be lacking in order to facilitate more women, more mentorship roles in secondaries?
Yeah, I think secondaries is a great place for female professionals and alternative investments, maybe broadly speaking. I think what we've lacked historically and what we're working on is educating women earlier about the career paths available in alternatives. So, as opposed to going a traditional investment banking route, I've been involved with the Women's Association of Venture and Equity, or WAVE, for probably over 20 years. Last year and this year as a co-chair, along with several other amazing women, for WAVE's annual career forum. And it seeks to really just do that. We invite our students to come from undergraduate and graduate programs for a day in New York City. We help pay for hotel rooms, and really have a full day of panelists around, what are the options in the options for careers in the space? What do they look like? Who are the people? Last year hosted over 350 students. We provide their resumes. The firms that sponsor that event all typically get those resume books, so that allows us the opportunity to follow up with the people that we meet. So I think that's a big part of it, is educating at a sort of younger or earlier point in terms of what are the options, and just providing more education. So anybody who's out there and listening, if you are a student and you want to attend, or you are a firm who wants to attend and support, please do reach out to WAVE. Be happy to have you.
Yeah, because I think a lot of people don't even know what secondaries are really. Like when they're in their university undergrad, it's a section that's this small in a lot of textbooks. So thank you for doing what you're doing for kind of the younger generation of women, you and Ares broadly, of course. And so lastly, what would you do if not in finance? Is there a hobby or a passion that our listeners would love to hear about?
I would say my fun answer is run a study abroad program at a college or university. One, I love to travel, but two, also I think it's very important for people to travel and get unique experiences outside of what they're used to on a day-to-day basis. That's sort of the fun answer. I think probably the more realistic one is to be a writer or an editor for an economic or financial publication. Similar to what I enjoy about secondaries, just that opportunity to learn, dig in, investigate. I also really enjoy editing work and sort of synthesizing.
You almost said people's work there.
Synthesizing ideas, making it more clear and digestible. So it's still on the fringes of finance, but I think that be more realistic career.
Well, I could see you in both of those roles, actually, both in the mentoring and educating facet and traveling and writing as well. So who knows? Life is long, right? You never know. Well, Kathryn, thank you so much for joining us on the show today. And it's truly an honor to have a chance to sit down with you and hear your insights into the intricacies of this really rapidly changing secondary landscape. And I think our audience really had a lot to learn in terms of the concepts you shared. And so I thank you for coming on board.
Thank you for having me. I appreciate it.
And as always, guys, thank you for tuning in and watching the Secondary Link LinkedIn page for updates on our next special guest. And we hope to see you in a few weeks where we highlight the next incredible woman on the Women of Secondaries.